All right. Good morning. Good morning, everybody. Got POW at 8 a.m. New home sales at 10. The EIA report at 10:30 is not much of anything, but you can often catch a little bit of a play on USO connected to that. Maybe X steel from time to time. Additional auction today at 11:30. Kind of want to be aware of that, and the 11 o'clock consumer confidence. So again, by noon, we ought to be done with everything. Still going to be expecting Fed members to be out there chipping their teeth. You really want to keep your eye on the bonds. We've broke through a major critical level when it comes to the bonds, and we don't quite know the ramifications of what's going to come with that. On the other hand, though, what the capital rotation is very clear. They're exiting bonds like crazy and diving back into the tech scene, back into the risk-on markets. Kind of faded off in the overnight hours. We're holding it at that consolidation level in yesterday's time frame. Looks like we may just be breaking back, but down below it. That purple line that you see is the daily 200 period moving average. Getting back above that was pretty important, but you can see the orange and the purple line cross each other. That's a 5200 daily moving average cross. Um, Historically speaking, that has been a buy signal throughout history when you look at, say, seasonality in the marketplace. So, gaming it out, two directions that we can go. We'll be expecting to retest that 200 period, say, like a Busby play. You can see how the market really struggled to get above it. So persistence beats resistance. We finally did break through. Now we're very likely to test against it on the other side. Keep our eye on that. It lines up really well with yesterday's open. It's a institutional pivot point. So, kind of gaming it out. Should we stay weak, then, we're likely to get a 1% move out of the day. That'd give us zero point 0.4. We've already got 0.4. That's 0.8. Right? So kind of holding the line somewhere around there. A total move on the day of around a -1% isn't out of line, and it really wouldn't be considered bearish. We've had such a massive rally since last Monday, basically. It would make sense that we pause a little bit at least, right? Plus breaking through that major moving average. Bring it over to the volume profile. So you can see this very sharp, aggressive resistance that we hit at 4,500. And we have some support at around a 44.50. So nice clear range to the downside. If we're looking for any upside move, um, I would run it intraday with, say, that 5-minute active fib plan that we use, because there's really nothing else that you could focus on other than something way back in early February. And it's unrealistic we're going to make that kind of a move today. I mean, it's absolutely possible, but just really unlikely. We came out of that nice compression yesterday, had a nice new bump up, and then we had those higher lows and equal highs going into the close. It's just very unlikely we're going to make that today, right? So 45.75 is on the table, but if we're going to move in that direction, we're going to need to see a lot of the risk on come into play, and we'd need to carry the others while we're at it. Anybody else not hearing me, or is it just homeboy here? Órale, güey. I will assume, since nobody else is yelling about not being able to hear, that it's probably dude. So that's gaming it out to the upside. That's gaming it out to the downside. Take a look at the NASDAQ. So the NASDAQ is above that 50. Um, the 200's got a long ways to go. We could consider the NASDAQ to be much more weak than the S&P. The financials are really going to be a game changer in the next few days if we continue to see this move in the bonds that we saw yesterday. We broke that critical level 2 days ago, continued it yesterday. It's a double bottom break, so we expected it to go lower than it went in the previous pivot point, but the fact that it continued to go lower yesterday um, kind of negates the whole idea that it was a double bottom at all. So S&P has financials, the Nasdaq 100 does not have financials. There's very likely going to be a ramification to that. Also, being a tech heavy index and the absolute ripping flow of capital rotation out of the bonds and into tech kind of makes you wonder why the Nasdaq is not, structurally speaking, in better shape. It has been a very aggressive move from 13,000, these lows that we had been hitting from, say, mid-February, all the way up to 14.8, really close to it anyways. So an absolutely phenomenal ripping move. Linear regression kind of implies we're going to give a little bit of that back. Makes perfect sense to see that we're weak this morning. You can see um, the swing high and swing low when we use the linear regression drawing tool. We're just now entering into the swing low portion. Right, kind of follow it through high, low, high, low, high, low, high, low. Well, we're back under the low. So the expectation is that we're likely to find support around 14,400 and or that 50 period moving average if we should remain weak. That 50 ties into yesterday's open institutional pivot point, makes perfect sense. A little bit of confluence there along the way. If we do move to the downside, we have a really close pivot point on Monday's RTH or Tuesday's Globex. They kind of line up really nice. So that would be like the last hurrah before we dump it down and tag that 50. Should this continue to stay weak, I've seen a little bit of news on Finance Juice that things have started to the Russian troops have withdrawn in some areas. Anything that implies some sort of ceasefire or you know a reduction in hostilities, we would expect to see a positive push. And I even mentioned it in the chat a few minutes ago, but we didn't see the reaction immediately that I was looking for. I expected gold to go down. I think my call out was like right in here. We got that move in the gold. We really didn't see much of a move in the equities on the other side of that. But that kind of news, you want to validate it, specifically in gold, maybe in oil a little bit. You want to see that VIX come off. And sure, we got the move in gold, but we didn't see the follow through in the other markets. Really keep your eye on the news today. If they do start to promote that talk of a ceasefire, or if they start talking more about a reduction in hostilities, I think you're really going to see this market leg up yet again, right? And I've heard people say for the last couple of days, like, surely we can't go any higher now. Yeah, there's a lot of capital on the sidelines, a lot of capital from retail traders that waiting to buy the dip, buy the dip, buy the dip. Uh, the institutions, on the other hand, they can't really buy the dip at these levels because the volatility is one of the constricting features of their plan, right? That they just can't trade the way we do. They can't run in and jump just because they want to. But with the volatility remaining low, like it has been, there's actually been quite a bit of talk that the reason the volatility isn't moving is because this move is being done with no hedging. You got to kind of game that out a little bit. Everybody's so confident in this move, they're just buying in and they're not using the hedge. So typically, when we see a kind of a rip rally like this, we see the the VIX fade because people are selling out of the VIX. They're getting rid of their hedges and they're piling into equities. Well, either they're not getting rid of their hedges or they didn't have any to begin with. So we're kind of missing one of those dynamics in the tools. Uh, with this capital rotation and the break in the bonds, we absolutely could see, another 300, 400, 500 points by the end of the week, especially when you start thinking about where the weekly expected move is. How many markets made it outside of their weekly expected move yesterday? Absolutely a phenomenal, just extreme move. Uh, Remember, there is such a thing as a bear market rally. Typically speaking, a bear market rally is anywhere from 10 to 15%. Well, there's 13 and a half to yesterday's high in the NASDAQ. So you got to kind of assume, you know what happens when we assume? You got to kind of assume we're just about as far as that bear market rally would take us before we don't consider it a bear market rally and we just consider it a rally. All right, we got the same model in the volume profile in the Nasdaq as we do in the S&P. A very, very strong level at the highest peaks. Now game that out and think it through for a little bit. The volume profile is measuring the last 10 days, and you can see that price was not at these levels in the last 10 days. It was only at these levels yesterday. Okay. So even though we're looking at 10 days worth of volume, and we can see areas down here where we spent days in this zone, the amount of volume that we had yesterday is almost as much as where we had days in a row in volume, right? Obviously, it's not the point of control, but for a single day, that's one hell of a lot of volume. Now, you could argue that it was a topping pattern and the institutions were getting out or they were piling in, right? But if they were piling in, I wouldn't expect this move down. So it looks like maybe a little bit of profit taking. We'll know more when we get the COT report next week. Right? It's not going to help us this week. But it's not just in the NASDAQ, it was also in the ES. And it's something worth noting, right? Look at how much time we spent there, which makes sense. But look at the absolute amount of volume spent there. So a fade to the downside is very likely going to find some support around that 14,400 area. That would put us through Monday's range and into, say, the trading day, Monday's RTH. There's nothing to catch the market. We've started the break to the downside here in the NASDAQ, and there's absolutely no volume support here. So we're very likely going to move through that area and come back down to Monday's targeted area before we find any support. So at least we got our destination in mind. All right, I was going to talk about the bonds. So I use the ZB. You could use the ZN, right? 10-year, 30-year, whatever you're comfortable with. But let's take it out to the higher time frame. And before I get rid of it, look at that weekly expected move and where we should have been for the week with a 70% accuracy. Price should stay inside that box, and we are well outside that box. This is like a 2 standard deviation move. You could look at something like a Z-score to see how far we actually did move beyond that zone, but it's a lot, right? You could basically copy the entire range of the week, set it to the downside, and you'd see that we've made almost an entirely new distance, right? If that's how far we should have moved between Monday through Friday, you take that, set it down here. We made all of that and then some. This is an absolutely critical level, and it was broken. This is important. It's got ramifications across the board. We can't even begin to speculate on how much this is going to affect things on a global scale, right? This is a real critical level that's been broken. I'm surprised we're not hearing more about it yet. We had an inverted yield curve the other day. It's a whole part of this break to the downside that we had. Let's see, what is today? Wednesday, Monday, right? So when we broke that double bottom, we also had an inverted yield curve on that day. It was Monday. The continuation yesterday kind of just picks up the extremity of everything. And we're still, even though, the market's we're not in RTH yet, we wicked it lower last night. So this is really important. And I'm just honestly surprised we're not seeing more about it yet, but you will. You will be hearing about this by the end of the week, I'm sure, especially if you listen to things like Investors Business Daily, um, Thinkorswim TV, things like that. You're going to start hearing about this. We really want to keep our eye on this today. See the bonds start to come back up. But in that move back up, we don't want to see any extreme, violent moves. Right? It's never good to see this thing moving extreme in either direction. Just nice and calm. Take it easy. Right? We don't want to see nothing violent or extreme. If you do start to see this really spike and begin to rip, slowly back out of your positions, right? I'm not saying you just got to shut your trade down, but start looking for an exit, fade that play, and get risk off, lock in some gains, get ready to see this market make a move. And it's not necessarily that I'm saying we're going to go down if this goes up, but that's not necessarily what I'm saying. I am saying that we broke a major, major critical level, and the ramifications of this would be something we'd have to go back years to see. But I can tell you now, it's not good. Right? So just heads up on the bonds today. Keep your eyes on them. A little bit of news came out on German government spokesman. No big news. Sanctions package is expected at the EU summit on Russia. Yeah, okay. Market didn't seem to care. Looks like they're going to try to open the Russian stock market again on the 24th. So tomorrow they're going to look to start opening a few markets up again. All right, we had that massive gap up move in the financials yesterday. It's a red to green on just an absolutely phenomenal level. So Tuesday closed, in the mid part of that red candle, rallied up. I guess that had been Monday. Rallied up in the pre-market, opened just well above the highest point of Monday, and nice little follow through. Typically, though, as much as this looks really good, a typical red to green has, like a 4% move on the day. It's one of the reasons I like them so much. So if we were to measure where the market had closed Monday and its highest point in the day yesterday, we're not even looking at, a 1% move. Worse than that, if you didn't get into it Monday near the close, you wouldn't have had that opportunity to get in down there at 38.81. You really only would have had a chance to make. Let's see, that don't make sense. Let's get her again. All right, so there's your 2.27%. It's not the 4% that I'm looking for. And then on the day yesterday, you had that 1% move. So a nice red to green, easy to spot in the pre-market, good follow through, but really not as good as we would have expected. And I know it's an ETF, right? And they just don't have the legs that equities do, but still not very impressive on the follow through. One of the really nice things though is we did get above that 50. I'd be a lot more excited about it, but that 50 is damn near sideways, and we don't give a damn about a sideways moving average, right? It has no respect for the market. Is worthless. So we can point at it and say, yeah, yay, we got back above the 200, we got back above the 50, but that 5200 really looks like it's going to cross, and we're back above it, but they've been sideways, so it doesn't have any validity, anyways. When we use the linear regression tool, just start at the left and drag it across. You can kind of start to see the high low. I know this other stuff is in the way, it makes it a little difficult to see. Get rid of it. This swing high, swing low, clearly in focus. You can see that, the secondary trend is to the downside. We are back up to the highest point, or very close to that high point. If we were to turn this linear regression line into a linear regression channel, we're outside the channel. So the only thing that we could do at this point to address a linear regression situation like this is if the market was to remain sideways long enough for the linear line to begin going sideways and then point up, that would give the market time to adjust the linear regression. The other thing would be, of course, if we just go back down again. When it comes to drawing tools and linear regression, every single candle counts. So while I'm on a daily chart on a 3-month time frame and we see this negative sloping line, if I go to a 2-year daily chart and we start to back that line up and use more data, well, now it looks completely different, right? We have a completely different bias, that we are just coming up off of the lows of that channel and we're not even back to the midpoint. So, when it comes to linear regression, the amount of data that you're using is absolutely critical. It's why you see a lot of CMT analysts only worrying about this much chart. It's the amount of data you're dealing with. So for the financials, you can see we broke that range to the upside. Kind of back it off just a little. More focused on, say, that right there. Nice little Busby play. Really need to see some support around 39. When we think about the sectors, the names that are in that sector become really important. Wells Fargo, Bank of America, they absolutely appreciated that move in the bonds yesterday. I want to see what they do with it this morning. Berkshire Hathaway gave a lot of it back. So did the XLF itself. So you can kind of see that weakness in the XLF, but not yet in Bank of America and Wells Fargo. Well, if it's not yet there and it can hold up at those levels until we get to the open, that's a play on the day that looks really good. So that's what I got for you guys. Be careful, be safe, and I will see you all in the Bullish Bears at 9:15 for the live stream.